Hey, everybody, and welcome to Victory's virtual workshop this week, where I unpack complex financial and economic topics and hopefully make them more accessible for you. I'm Patrick Huey, and today is February 14th. Happy Valentine's Day, everybody. Today, we're delving into a fundamental aspect of your finances. Once again, it's taxes, and this time, how to get more deductions by using a tactic called bunching. So grab those headphones and something to jot down some notes and join me as we explore a way to lower your taxes when you bunch. Just a reminder for everybody to feel free and jump into that chat, ask any questions, paste those questions in there, and I'll try to answer as we go along. Again, here is what that button looks like. Or if you need more personal questions, something that needs to be taken offline, I'll certainly reach out to you afterwards. And again, a transcript will be available to you on Friday, as well as a video recap. So let's get going. Start off, let's define what we mean by bunching tax deductions. Well, bunching is a strategy where you concentrate your deductible above the line expenses into a single year instead of spreading them out over multiple years. That means things like mortgage interest, medical expenses, and charitable contributions can all be bunched. And at the state level, at least, you can even bunch 529 plan contributions. What that does is lower your tax in the year that you do it, at least potentially if you do it right. So why should you consider bunching tax deductions? Well, one consideration might be the timing of bunching, meaning, for example, if you anticipate a significant increase in income in a given year, it might just be advantageous to bunch some deductions and offset those higher taxes. Otherwise, all things being equal, it might just save you money. It might just lower your taxes in the year in which you bunch. So let's dive further into the strategic value behind this approach. First, it's important to recognize that the U.S. tax system allows taxpayers to choose between taking the standard deduction or itemizing their deductions. With the standard deduction amount increasing in recent years since the Tax Cut and Jobs Act of 2017, fewer than 1 in 10 people now are itemizing. However, for those who have significant deductible expenses, such as homeowners with mortgage interest or individuals with high medical expenses, itemizing can still yield substantial tax savings. And bunching your deductions becomes advantageous when, by doing it, your itemized deductions in that single year exceed what the standard deduction would have been. So by concentrating all your deductible expenses in a single year, you exceed that standard deduction threshold and reduce your taxable income and lower that tax bill. Future years are not affected as you still qualify for the standard deduction. So let's break down some scenarios where bunching tax deductions can be strategically beneficial. Okay, consider a homeowner with property taxes. Instead of paying the same amount every year, they choose to pay the tax for 2 years in a single year. For example, you'd pay for 2024's tax in November and then turn around and pay 2025's tax before December 31st of 2024. You just bunched 2 years of property taxes into one. And by doing so, you'd effectively double the amount of property tax deductible in that year, potentially surpassing the standard deduction threshold when combined with some other deductions and yielding what I think are significant tax savings. Similarly, for individuals with high medical expenses, bunching deductions allows them to concentrate their medical expenses in a single year and could involve scheduling things like elective medical procedures or treatments, purchasing necessary medical equipment, or paying health insurance premiums early. Think paying January's premium in late December, effectively making 13 payments in the bunching year. Charitable contributions also offer massive opportunities for bunching deductions. Rather than making sporadic donations each year, you can consider making larger contributions every couple of years, or use a donor-advised fund to make your future year's contributions all at once, and then parcel them out from the fund over time. And as we mentioned, in the realm of state income tax planning, you can look into bunching in a 529 plan if you're utilizing one to stash away money for children or grandchildren's future education expenses. About 30 states offer a state income tax deduction for 529 plans in their state, and you can make up to 5 years of maximum contributions in advance. It's important to note that bunching deductions requires careful planning and consideration of your financial situation. You'll need to evaluate your cash flow, obviously, your anticipated expenses, and any potential changes in tax laws to determine the most effective bunching strategy for your circumstances. We'll talk about some of those potential changes in tax law in a second. But bunching is a bit time constrained now because of those potential changes to the law. The 2017 Tax Cuts and Jobs Act, which we already mentioned, is scheduled to sunset at the end of 2025. And without congressional action, we'll go back to the old tax regime with a lower standard deduction. So you may not want to bunch more than 2 to 3 years of, say, charitable contributions until there's a bit of clarity on how that's going to pan out. And that, quite honestly, may not be for quite some time. Here is a very simplified example. Now, without bunching, these taxpayers have $19,000 in charitable donations and $5,000 in property taxes. She and her spouse get no benefit from her donations, as she only qualifies for the standard deduction in all 3 years. Now, with bunching, she now has $57,000 in charitable donations, and she also bunches 2 years of property taxes to add $10,000. Her deduction in year 1 is $67,000. And in year 2 and 3, it's the same standard deduction of $29,200. The difference in deduction in year 1 is $37,800. And that's the actual deduction minus the standard deduction, gives us that $37,800. In the 22% tax bracket, this saves you about $8,500 in taxes. And in the 33% bracket, it would save you closer to $12,500. Now, as always, it's recommended to consult personally with me and your tax professional to determine the best tax strategies for your individual circumstances. And there you have it, bunching tax deductions to save or offset taxes. Now, one question did come in early on, and that was, is this considered a legitimate planning strategy? And the answer is absolutely. It's widely discussed in financial journals and in the media, and it's a form of tax minimization and not tax evasion, which is where the trouble starts. So no worries there. Thanks, everybody, for being with me today. Be on the lookout in the weekly briefing email for the next topic for our virtual workshop. Thanks, everybody, and we'll see you next week.